Ladies and gentlemen, good day and welcome to the Q1 Financial Year 2022-2023 earnings call of MPS Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman and Managing Director. Thank you, and over to you, sir.
Everyone from Noida, and welcome to our Q1 FY23 earnings call. Today I have with me Sunit Malhotra, CFO of MPS Limited, Sukhwant Singh, Chief Delivery Officer of India, and Rajesh Jumani, Chief Revenue Officer at MPS Interactive, who joins us from New Jersey. In our opening segment, Sunit will kick things off by discussing our Q1 FY23 performance. Then Sukhwant will update us on the content business. Next, Rajesh will discuss our robust performance in the e-learning business. And finally, I will discuss how FY23 is shaping up and will also articulate and quantify Vision 2027. Let's get going. Over to you, Sunit.
Thanks, Rahul. Q1 FY23 was somewhat muted for MPS after a record-breaking FY22 at INR 114.04 crores. FX-adjusted revenues were down by 3.3% against previous year, primarily driven by three factors: movement of large K-12 projects to the balance part of the year, which largely impacted the content solutions business; delay in delivery for a sizable e-learning customer from our Swiss entity, which somewhat picks up in Q2 but starts to perform in the H2 FY23. A decline in the high-wire business, which is now expected to be soft all of FY23. I would now like to hand it over to Sukhwant to discuss the content solutions performance in Q1 FY23 and overall prospects for the business in FY23.
Thanks, Sunit. So our content business serves two primary markets, education and scholarly. As Sunit shared, the content solutions made a soft start to FY23 because of the lopsided nature of how education vertical is expected to perform this financial year. However, the scholarly business outperformed and is expected to do well in a sustainable way. For example, revenues in journals grew by 15% over previous year in Q1 of FY23, while operating profit increased by 47% over the previous year. Similarly, scholarly books revenue grew by 8% over previous year in Q1 of FY23, while operating profits for scholarly books increased by 77% over the previous year. I would like to now hand it over to Rajesh Jumani to discuss the MPS Interactive Systems performance in Q1 of FY23 and overall prospects for the business in the FY23. Over to you.
Thank you, Sukhwant. As Sunit shared earlier, a Swiss subsidiary made a soft start to the year due to a delay from a sizable strategic customer in Switzerland. That business, however, is a small element and is expected to bounce back in the second half of FY23. At MPS Interactive Systems, we are all elated with the progress in the business and are looking forward to a full year and seamless expansion in FY23. In Q1 alone, our revenue grew by 15.2% from a consistent flow of projects from our staff accounts. Profitability improved as the business recorded an EBITDA of north of 30% in Q1. Our order book expanded by over 20% as we book significant orders. Our pipeline is robust across different types of work, including learning advisory and consulting, immersive learning, continuous learning, learning technologies, and training delivery. And apart from geographic diversity, the pipe is varied across training strategies, including onboarding, product training, sales enablement, soft skills, DEI, sustainability, leadership, and compliance. Back to you, Rahul.
Thanks, Jones. While the start to FY23 has been soft, we continue to be bullish about the year. To summarize, there are certain factors that are giving us confidence. First, our content business is doing exceptionally well with our scholarly customer base. We are at the early innings of this growth story for this customer base, and this will continue to unfold through the rest of the financial year. The education practice is having a lopsided year, as Supan described, with a few delayed projects. After a steady pickup in Q2, things will generally roar in the content business in the later part of FY23. Second, while we reported double-digit growth in Q1 in the e-learning business, our ambitions are higher and will only be unlocked when aspects of the e-learning business do well, including the 2 European subsidiaries. We have still not reported a full quarter of EI's earnings. This will show up in its entirety for the first time in Q2. Coming to the platform business, while we will have a final decline in FY23 due to Highwire, and this tends to be an issue with our previous acquisition strategy of acquiring distressed assets at distressed prices. While we see a massive ROIC during an impressive payback period of 3 years, growth only unfolds in the 4th and 5th years. We are seeing, though, growth in the scholarly content business due to the acquisition of Highwire. To conclude my comments on FY23, our theme for the year is to cross 100 crores in PAT. Market stalwarts tell me that this new scale will open up new doors for MPS. And all of us at MPS are diligently working on crossing this 100 crore PAT level in FY23. Now moving on to Vision 2027. Some of you may have noticed that this was articulated in our annual report as to create a compelling learning company at a meaningful scale that helps the world learn smarter. We aspire to be the provider of choice in our markets that powers experiential learning experiences with the latest tech innovations. Our EEE values of excellence, efficiency, and empathy continue to endure and serve as guiding principles toward Vision 2027. And while we have not shared the quantification of this Vision 2027, we do that today as we set our ambitions at revenues north of 1,500 crores at expanded margins by the end of FY27. We look forward to your continued support in this exciting new growth phase of building scale. I would now like to open the call to your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Rishikesh Kare, individual investor. Please go ahead.
Yeah, I was just checking the cash balance. It has gone down from 182 to 125. Now, after factoring the dividend payment of 52 crores and acquisition cost of 40 crores, generally you have it seems generated cash of 30 crore plus, which actually translates cash earnings per share.
Mr. Kale,
Sorry,
the
you
voice
broke
was
up.
breaking. Can you please repeat?
Yeah. Am I visible now? Am I audible now?
Yes,
Yes.
sir. Please go ahead.
Yeah, I was just checking your cash balance, which has gone down from 182 crores to 125 crores in this quarter. But assume that is after factoring the acquisition of 40 crores and dividend payment of 52 crores. So you seem to have generated cash of 30 plus crores or 18 plus cash earnings per share this quarter. So why is there such a divergence between your cash earnings per share and your reported earnings per share?
Go ahead.
So there are 2 things which have happened here. One is you've correctly stated the acquisition cost of that 42 crores for the EI design and the dividend part.
Yes.
And this includes, in fact, when you're looking at the consolidated cash balance, in fact, there is a intercorporate loan which has moved from one entity to another of 15 crores. And so if you look at the entire thing, the dividend has also been paid out. But the dividend, the other certain part has also been paid out in the month of July. So the entire payment has not been made in the month of June. Certain payment has spill over to July also.
Okay. So what would be the cash earnings this quarter, like after factoring the spillover?
in fact, we have not exactly worked it out, but over a period of 1 year, if you look at our last year audit financials, it would be close to 80 crores every year that is generated out of the business.
And this year, do you expect it to be higher?
Just to interject there, so that the 80 crores was on a PAT of 87 crores, so we should follow the same ratios going forward as well. There is no change in the nature of the business in terms of working capital.
Okay, fine. Okay. So we would expect around 100 crores cash generation this year?
Again, we're gunning for more than 100 crores of PAT. So depending on if obviously the cash flow and PAT don't seem to be equal in our case.
Mm-hmm.
So yeah, again, we're not really monitoring cash flow. We tend to have a fairly strong balance sheet.
Mm-hmm.
But yeah, we are gunning for north of 100 crores on PAT.
Okay, sure. Okay, thank you.
Thank you. Participants are requested to press star and 1 on their phone to ask a question. We have our next question from the line of Umang Shah from Sarat Capital AIF. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, the first question was, if I look at FY22 numbers and if I remove TopSim out of it, our platform division revenues have moved down from 120 crores to 108 crores on approximately. So, sir, is this entire decline attributable to iWire, or is the Think 360 and other platform also reason for the same?
So I didn't understand your TopSim comment because TopSim is part of the e-learning business. But yes, your observation is correct that all of the decline in the platform business is from iWire.
Okay, sir. And sir, this is for FY22, right? So what was the reason for this decline?
So, that requires a sort of a bit deeper understanding of the acquisition strategy, and I'll maybe step back and explain that to you. So, historically, before the acquisition of EI Design, the 7 acquisitions that we did, we were basically looking at acquiring distressed assets at distressed prices, which meant that, on average, our payback period would be 3 years, and during that payback period, we would have a very high ROIC. And growth would really start to unfold in the 4th or 5th year. That was our old acquisition strategy. We acquired iWire really in July of 2020 during the middle of the pandemic. In 2022, we're still, we're just on the 2-year mark. With iWire, we see that same acquisition playbook playing out. Of course, going forward, we've modified that acquisition strategy towards acquiring growing assets like EI Design at compelling valuations. But yes, with iWire, we will see that 5-year cycle play out and growth truly only coming in the 4th and 5th year.
Right, sir. Thank you for this explanation, sir. Sir, the second question was, Mr. Jumani has been in Tata Interactive for a very long time. And now when he assigned the role of a global revenue officer, is it for the entire group or is it only for the learning division?
It's for the MPS Interactive business, the e-learning business.
Not for the entire MPS. Not for the entire MPS group. And how is this role, like, it's not the CEO role, right? So what does it entail?
It is responsible for developing the revenue of the e-learning business.
Right, sir. So in the overall chain of command, who's the one who would be taking care of the e-learning business?
So we have split responsibilities. The revenue responsibility sits with Ajay Jumani, and the delivery responsibility for India sits with Sukhwant, who shared the opening remarks. And the European responsibility for delivery sits with Attila Varga, who is the managing director of the entities in Europe.
Right, sir. Right, sir. And the last question is, the EI Design acquisition, is it on the timeline as you envisaged with respect to integration?
Yes. So that's the beauty of acquiring a growing asset. There's not much of integration to be done, but yes, we're about 8 weeks into the process. Everything seems to be on track. We're in fact running ahead of schedule. So we're very satisfied with the progress of the acquisition. And like I said, there's no turnaround required here. It's more around driving growth, and we're on track for that.
Great, sir. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, a reminder to press star and 1 to ask a question. We have a next question from the line of Arjun Goel, an individual investor. Please go ahead.
Hi, sir. I have a couple of questions. Firstly, on the EI design, now that the acquisition is complete, can you share the financials for financial year 22? Like, what was the revenue, EBITDA, PAT for the company? I think in the presentation it was only up to 9 months.
Okay. So, and what's the second question?
The second question was regarding the vision for 2027, which you highlighted. You said that I think you said that the revenue is 1,500 crores, right?
Yes.
So that's 3 times in 5 years, which is a CAGR of about 25%. So I wanted if you can throw some more color on how you're going to achieve that. That would be very helpful, because from what I understand is that the content business is a mid-single-digit margin, mid-single-digit CAGR kind of business. So if you can throw some more color on that. And finally, I have a question on the possible dividend, which I'll get back if you can just answer these two first.
So I'll answer the question on the vision for 2027, why we feel confident about revenues north of 1,500 crores at margins, at expanded margins, and then I'll also touch upon the dividend question. Meanwhile, Sunit will come back then and talk about the EI design numbers for FY22. So like you rightly pointed out, we have 3 business segments: content, platforms, and e-learning. Your observation that the content business is a single-digit growth type of business was, our kind of conclusion as well pre-pandemic. But as we've seen, in the last couple of years, that's started to change, and we expect this business to start growing in double digits now, including FY23. I understand we've had a bit of a lopsided situation here with growth coming more in the second half of the year, but we're feeling very confident about the content business growing at double digits, and we believe it's sustainable. What has essentially happened in this particular business segment is that customers have reviewed their supply chain and now looking to consolidate with scale partners that have serious tech IP. So that's the big change that's taken place. So we're getting more volume from existing customers, but also acquiring new customers. So we are more bullish about the content business in general. The e-learning business, as a market, depending on what report you look at, is growing between 15 and 20%. We feel that organically our business can also grow at that same clip. And keeping the 2 European subsidiaries aside, we actually did grow, as Sukhwant described, or rather Jums described, north of 15% in Q1 alone. So we expect our e-learning business to grow at a 20% CAGR without new acquisitions. And then the platform side, once we hit the 4-year, 5-year mark with Hirewire, we expect that business also to grow, at a 20% clip. We also have a fairly active acquisition strategy. We are hoping to do, a couple of acquisitions a year, over the course of the next 5 years. And we believe we can get that done because of our modified acquisition strategy, which includes acquiring growth assets rather than acquiring distressed assets. So, with the blend of organic and inorganic growth, we feel very comfortable with this, projection of revenue north of 1,500 crores at expanded margins. Just to reflect back also, when we started this journey back in 2011-12, this was a 125 crore business. Today, if you look at last year, it was 450 crores. So we've done this before. Yes, it took us, 8-9 years to do. But now we have a certain scale that gives us confidence that we can do it again, but at a faster clip. Of course, there's lots of moving parts in our business. Having said that, the number that we're pointing out here, the management team feels very comfortable. In terms of, I know this question will come up after this, so I'll preempt it and proactively answer it. In terms of financing some of this growth, especially on the inorganic side, we are open to looking at, if our focus is, of course, internal accruals, but if a sizable opportunity, for example, presents itself, we are also looking at options of debt and equity both. So there's another nuance to financing where historically we've only looked at internal accruals. On dividend, I think dividend buyback, it's something that the board talks about periodically. I think we've been fairly our track record is fairly strong on this front. We tend to, if we do not see any deployment of capital possible, we tend to redistribute surplus funds fairly quickly. So I think we will carry forward. I believe we'll carry forward that track record. And again, the focus here, of course, is to beat 150 crores at expanded margins in the next 5 years. And of course, if during the journey we find that we're sitting on surplus funds, we will redistribute those funds. I'll just give it a transition to Sunil to talk about the EI design numbers for FY22.
Sure.
So for EI design, we are on track. The first month, in fact,
FY22 last year.
FY22 last year was 32 crores of the revenue which was there, and they reported a profit before tax of 9 crores, and profit after tax was, the tax rate was 26-27% there.
Okay. So I just have a couple of follow-up questions. Firstly, regarding the vision part of it, my follow-up is basically that any acquisitions, assume that you don't do any acquisitions in the future, then do you think that 15 to 20% growth on the current assets that we have, is that sustainable for the next 5 years? Would that be fairly accurate?
Sorry, could you repeat that question, please?
So let's assume that you don't do any acquisitions in the future, right? And you're guiding for a 25% CAGR for the next 5 years. So X of any acquisition, do you think of 15 to 20% growth is sustainable on the current business that we have?
So the numbers I gave were a blend of organic and inorganic, and what we've assumed is again, I'm ballparking here, but like a 50-50 split, 50 coming from organic and 50 coming from inorganic.
Okay, fine. Fair enough. Actually,
I just want to correct myself. So the figure which I gave you was for FY21. For FY22, the revenue was 38.88 crores.
38.88.
Yeah.
Okay. And profitability?
Profitability was 8.20 crores.
That's before taxes? Or
this is profit before tax.
8.2?
20 crores.
Okay, fine, sir. Fine. Okay, and so just a follow-up lastly on the dividend policy. I mean, a couple of calls back, I think you mentioned that you want to maintain an approximately 150 odd crore cash balance just for acquisition. So assuming you make about 100 crores of cash profits this year, can we expect the same sort of policy that anything north of 150 odd will be paid out? Would that be fair, or does that?
Yeah, I would confirm that right now, but if suddenly I'm presented a $25 million business at a 25% EBITDA margin, I want to take a stab at it, I will.
Sure.
So I confirm what I said last quarter, with the caveat that if an opportunistic play presents itself, which allows us to go faster towards our Vision 2027, we will execute on that goal.
Okay. Thank you, sir, and all the very best for the rest of the year. Thank you.
Thank you. Participants are requested to press star and 1 to ask a question. We have our next question from the line of Rahul Jain from Dolat Capital. Please go ahead.
Hi. Congratulations on the strong numbers. Just wanted to clarify, I think just a moment back you said half of the incremental revenues that you are envisioning would come from organic and rest from inorganic. So is it safe to assume organic will go from 500 to 1,000? Is that what you're trying to interpret?
Yeah, again, ballparking here, Rahul, but roughly that,
Yeah. Okay. And secondly, from the segmental outlook that you gave, that content can sustainably grow in double digit, I understand that we have done decent in the last 1 or 2 years in this business, but What is adding to the confidence that it is a more sustainable thought? Because you are saying that this is coming because from a volume share expansion with the customer. So are there significant opportunity left for us where we are smaller in an account where we could expand to those volume growth? What is driving that?
Yeah, I'll answer that in two ways. So, as Sukwant explained in his opening remarks, the content business has two markets: the education market and the research market. The research market, post-pandemic, organically is growing at 10%. So there's far more research being published today, on average. Because there's an organic sort of lift happening in the market itself, it's giving us some confidence. Now, within that market, we have, two types of customers that are large and scaled, and want to work with providers like MPS that are also large in scale from a relative standpoint. Then there's another customer base, which is a mid-sized publisher or a university press or a society. They want to work with vendor partners that are more complete, and the acquisition of Highwire Press has made us more complete. We are seeing, for example, a lot of growth on the content side of our business coming from the Highwire customer base. So between the market pie expanding, large customers within that market wanting to work with scaled players like MPS, and small customers wanting to work with players like MPS that are more comprehensive, we're very bullish about the research part of our business, which also tends to be a higher, margin business compared to other parts of our business. On the education side of our business, again, we are seeing a drive of publishing companies turning into subscription-based companies. And as they become subscription-based companies, the volume of content that they need to produce is going up. So think of, from the volume of content that used to get produced, for example, on the cable network side, there's a farm, in the Netflix model, you're seeing companies like Netflix produce far more content than what was produced during cables. Similarly, as publishers move to a subscription model, they will have to produce more content on the education side, and as they produce more content, there's more work for us. So that's one part of the education story. The second part of the education story is that we are now starting to work with educational institutions directly. So, for example, we're working with many US-based and European-based educational institutes where we are developing a lot of their courseware. This is an entirely new market for us that we entered about 18 months ago, and we have already now developed customers that are north of $1 million in revenue in this particular market. So again, combination of traditional publishers becoming subscription-based platforms, producing more content, therefore more opportunity for us. Plus, for us, servicing a new customer type, which is educational institutes, is giving us, more optimism about this market. So that's really on the content side of our business. Having said that, there's also this element of small base effect. Our content business, is much smaller than some of our larger competitors, and some of them are 2x or 3x of our size. So as we play catch up, we will definitely be going faster than them. So there's also a small base effect element to this as well. So very bullish about content, including FY23.
Yeah, just a small clarification. You said the US European-based education institute that you started working 18 months back, and you mentioned something like $1 million. What was that? I missed that part.
Yeah, so we are working with a US-based university to develop over 50 of their courses. These courses are targeted at professionals that are, consuming these courses as they are working professionals, consuming these courses on the side. So these are more professional development courses. So we're developing 50 of these courses for a university. Traditionally, we would develop these courses for publishers, but now we're also working with universities directly.
And this size of such deal could be $1 million. This is what you're trying to say.
Yeah, and what I'm trying to say is this one customer is, we've developed a few customers, and these customers are over $1 million in average. So as we scale this type of revenue, there's only a handful of customers today. There's a huge potential to scale this business. That's the point I'm trying to make.
Sure. And on the platform side, what excites you? Just the high wire part once our post normalization would do better, or is there more legs to that?
So more legs to that, of course, on the high wire, piece, of course, will only settle down like I described. We're hoping that we would go faster than our previous acquisition playbook, but it's kind of running its normal course. What's giving us confidence is that while we've lost customers that historically were associated with high wire, we are gaining new customers. On the high wire side and on the platform side of the business, we have a three-pronged approach. We are playing a price warrior approach, given that on the platform side of our business, most of our competitors are based outside of India. Because of wage arbitrage, we're able to play a price warrior approach to create market share. The second thing that we're doing is we're following a product bundling approach. So we're combining a lot of our SaaS products and opening up opportunities as a result of that. And the third thing that we're doing is, wherever possible, we're combining the platform offering with the content services offering, which again is giving us a lot of conviction that and we've cracked several deals in the last 6 to 12 months across these three strategies. So as the decline stops, the growth will start to show up because while we have churn, we also have addition. Currently, the net is negative, and we're hoping that by the fourth year it will be positive.
Got it. Thank you. That's it from my side, and best of luck.
Thanks, Rahul.
Thank you. Participants are requested to press star and 1 to ask a question. Our next question is from the line of Rishikesh Kare, an individual investor. Please go ahead. Mr. Rishikesh Kare? One moment, please. Mr. Kare? Mr. Kare, can you please go ahead?
Yeah. Hello. Am I audible?
Yes, sir. Please go ahead.
Yeah. In the Q3 Concall, I had asked a question, and you had said that you would be beginning the journey for reaching 35% operating margins. But this quarter, there has been a slight drop. In fact, it has gone down to 25.8%. Is there any specific reason for this, or is there any one-off?
Yeah, the revenue. So, like I said in the beginning of the call, the education business seems to be performing better in the second half of the year, even though the research business has already picked up. So it's more seasonality of revenue. Not really seasonality even. It's more delaying of certain projects. But on average, we should be okay by the end of the year.
Okay.
Thank you. We have our next question from the line of Keshav Garg from CCIPL. Please go ahead.
I just wanted to understand that how is the demand looking in our various segments in the context of the recession and economic slowdown in Western markets?
Yeah, so far, again, something that we are actively monitoring, both on the sales side but also on the operation side. Currently, we still are not seeing any manifestations of that. There is, yes, on the education side, certain projects have been delayed, but they have not been cancelled or abandoned. So as of today, not seeing any impact, but something that we are actively monitoring. The academics say that people tend to spend more in education and learning during a recession. Now whether that academic concept plays out in the real world or not, time will tell. But so far, not seeing anything different for us at least yet. But of course, time will tell.
Sir, and in December 2020 quarter, we made the highest EBITDA per quarter of 33 crore, and since then it has been stagnating at around 31, 32 crore, and last quarter, June quarter, we did 30 crore. So going forward on a quarterly run rate basis, what kind of EBITDA should one expect?
Yeah, it's very difficult to give, quarterly guidance. Again, I'd go back to my opening remark that we are gunning for north of 100 crores of PAT this financial year.
Great. And lastly, in the AGM, it was mentioned that in our platform business, we are expecting from fourth quarter of this financial year or then first quarter of next financial year, we'll start growing at 15-20%. So you think that still holds?
No, that doesn't hold. Like I was saying, we were more optimistic. We were optimistic that this will play out better than what we've seen in the past, but this seems to be playing out at par. So basically, we start to see growth in the fourth year.
Okay. Thank you.
Which is 2024. Yeah.
Okay.
Thank you. We have our next question from the line of Arjun Goel, an individual investor. Please go ahead.
So, in the recent past that rupee has depreciated so much against the dollar, what impact will it have on our revenues and profitability, assuming it stays at this level for the rest of the year? If you can talk a little bit about the forex element of the financials.
Yeah, I think so. So we tend to our hedging strategy is very straightforward. Our goal is to cover our receivables, but really, as if the rupee stays at this level or continues to depreciate, of course, it will go straight to the bottom line, and we're seeing that happen as other export businesses and other IT businesses are seeing. So it should go straight to the bottom line.
But I think other IT companies are also facing an attrition problem and wage inflation to counter it, right? So are you also facing similar issues? What is the attrition? How much is the wage inflation? Things like that.
I think, yeah. So we have a slightly unique setup where we have about 2,600 employees. 97% of them are based in India.
Right.
Having said that, in India, unlike, we have 7 centers. So most of our competitors, or the IT space in general, if you had 2,000, 3,000 employees, you would be at the most in 3 locations, if not 2. And we've done this, fairly. While this happened through acquisitions, we've maintained it with fair deliberation. And the reason for that is that if a talent shock does take place in a local environment, we are hedging ourselves by being present in 7 different centers. And same goes for us internationally. We have 3 centers in Europe and 5 in the US as well. So while I wouldn't say our attrition levels have reduced, what I will say is that many of our competitors, the attrition levels in our industries has been at 2.5% for many years now, a month. For some of our competitors, this has gone up over 3%. In our case, it's just stayed the same. It has not improved. It has not declined. It's just stayed the same. So for us, this is a competitive advantage for us, being so distributed. So we haven't seen the same impact, at least yet. We haven't seen the same impact that some of our competitors have because of this distributed workforce.
Right. So, sir, the delta in the margins from the next quarter, assuming the rupee dollar rate remains at about 80, it should lead to a massive delta, right, in EBITDA margins. Am I reading it correctly? Or is the hedge rate also at about 80? I'm not entirely sure how it works, but is that fair or?
Yes, it's fair. So basically, as the rupee depreciates, it goes straight to the bottom line.
It goes straight to the bottom line. Okay, thank you, sir. Thank you, sir.
Our internal budgets are prepared at 74, if that helps.
Okay, thank you.
When we plan our expenses, we budget at 74.
Okay, perfect. Thank you.
Thank you. We have our next question from the line of Sachit from Param Capital. Please go ahead.
Yeah. Hi, Rahul. Congrats on a good performance. First thing I wanted to check with you is, in this particular quarter, there would be some contribution from AI Design, right? Is it possible for you to quantify? I believe it would be a 1-month revenue, right?
Yeah, $400,000. Again, giving you a ballpark estimate, Sachit.
Okay. Second is, this is more structural kind of a thing that I wanted to understand. That like now you're talking about a potential your vision of 1,500 crore revenue. So what all
You didn't thank me for quantifying the vision. You've been chasing me for 9 months now.
yeah. No. Thank you so much for doing that. So I just wanted to understand what organization level changes you would want to change to get to that vision, because you're talking about competing with larger players in the content space. So just wanted to get your sense on, is the the second level management and all ready, and that bandwidth can be handled by you. That's what I wanted to understand from you.
Very good question. Very excellent question. So we've been working on this now since 2018. So we formed a senior management team, firstly around 2018, right after the acquisition of Tata Interactive. So we have 8 people in the senior management team. So rather 9 people in the senior management team. 3 of them have been with MPS since we started our story. Sunit, myself, and Naren, CTO, CFO, and Chairman and CEO. 3 of them came from acquisitions. 2 of them from Tata Interactive. 1 of them from Highwire Press. And 3 of them were external hires. 2 of them from larger competitors, which says a lot about MPS, that people in senior management positions are willing to move to a smaller company. And the third and the 9th one is Sukhwant, who shared the opening remarks, who is a graduate from our management program that we have in collaboration with ISB. So every year with ISB we onboard 4 to 6 management professionals to basically be the future leadership of the company. We've started this program again back in 2018. Again, Sukhwant is a graduate of that particular program. So there's one initiative which was forming the senior management team. There's this other initiative that we're doing in collaboration with ISB. The third piece that we've done is we've very definitively looked at the next 3 layers of the organization. So from the senior management team, then the next 3 levels, and we've made sure that across each of those levels we are well represented. People have bandwidth, and we have good management depth. So that's been an exercise that we've been carrying out very intentionally now for many years. On top of that, we are also exploring now an ESOP program to make sure that this massive talent pool that we've created over the last 3-4 years performs as co-owners rather than as employees. So that program is currently under discussion at the NRC of MPS, and hopefully will be launched sometime this financial year. So there's been a lot of thoughtfulness, effort gone into building the team, and now it's about making sure that this team continues to grow and prosper.
Great, Rahul. Those were my questions. Congrats once again for great set of numbers, and all the best for future quarters.
Thanks, Sajid.
Thank you. For any further questions, participants are requested to press star and 1 on their phone. We have our next question from the line of Umang Shah from Sarat Capital AIF. Please go ahead. Mr. Shah? I believe his line is disconnected. Participants, Mr. Shah, are you there?
Yeah, can you hear me?
Please go ahead, sir. Yes.
Yeah, hi. Thank you for the opportunity again. Sir, we have 2 divisions, which is content and e-learning. In content, we have limited number of customers and limited number of competitors because it's a fairly consolidated space. While on e-learning, we have a very fragmented industry and a large number of customers. So when we are looking for new deals or when we are pitching for new deals, what are the key determinants in both set of segments? And can the sales force be fungible in both these segments?
Yeah, so content gets broken into 2 ways, right? Research and education. So yes, with the research side of the business, it's pretty spread out. So you have you rightly pointed out with the large and mid-sized publishers, it's a finite set of customers. But then there's this whole universe of university presses, societies, which is much larger. So on the research side, there's definitely an opportunity to grow within this customer base. And from a representation standpoint, the Highwire relationship base has given us kind of a springboard to unlock this particular marketplace. And then on the education side, again there's different dynamics. You have the traditional education publisher that is trying to pivot to a subscription-based business. You have an educational institution type of business, which is slightly different, and then you have an edtech business, which is some of the new edtech players that are emerging. So what we've done essentially is we've created a different sales type of organization for each of these markets. So we have sales teams focused on research. We have and marketing teams focused on research. Similarly, we have sales and marketing teams focused on education. So that's on the content side. Having said that, like you rightly pointed out, on the content side of our business, whether it is research or education, a lot of it is referral and word of mouth. So it's more old school that way. On the corporate side of our business, it's more marketing led rather than sales led. So we've, for example, with the acquisition of EI Design, while we've acquired a great asset in terms of an operational delivery model, what we also acquired is an asset that has a great digital marketing engine. So, for example, every year they generate about 1,000 leads, on average. So very, very mature marketing model. Because the market is so fragmented, both in terms of vendors and customers, marketing is the strong sort of driver towards creating growth, because it's impossible to attack this with a feet on street model because there's so much opportunity. So our focus is more around having a great compelling marketing message, which then builds inbound interest, which then is unlocked by our sales team, versus the content side of our business, which is more outbound. So there's an outbound inbound element to this as well.
Got it, sir. Got it. This is very helpful, sir. Thank you.
Thank you.
Thank you, Mr. Shah. Ladies and gentlemen, to ask a question, you're requested to press star and 1 on your phone now. Please press star and 1 on your phone to ask a question. As there are no further questions, I would now like to hand the conference over to Mr. Rahul Arora for closing comments. Over to you, sir.
Thank you so much to everyone for all the support and insightful questions. Your questions always allow us to introspect and do better. We've, like I said, like Sunit pointed out, we've had a muted start to FY23. Although our eyes are set on FY23 to cross 100 crores in PAT. We have now also quantified our vision for 2027, which is to be in excess of 1,500 crores in revenue at expanded margins. We look forward to your support. This next phase of MPS is about building serious scale. And again, thank you again for the past several years where you've been really patient with us, and look forward to your support going forward as well. Thank you so much.
On behalf of MPS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.